So estate planning is a bit like packing layers for a long walk. You don't want to carry everything you own, but you do want the right things for the right conditions. Life insurance plays a similar role. It's not about loading up with maximum cover, but having the right protection in place for what you're trying to achieve. In this episode, we'll look at how life insurance fits into estate planning and real situations, and why it's a moving beast that needs regular attention. I'm joined by Alex Pugh, a chartered financial planner and partner at Saltus. Alex, thank you for joining.
Thank you so much for having me.
Alex, could you give a high-level overview of what life insurance is?
Yeah, no, absolutely. So life insurance effectively is where you have a contract, and if in that your untimely death, and the provider will pay out a certain sum assured.
And why is it useful for inheritance tax purposes?
Look, so inheritance tax has become, it's always been a very emotive tax for want of a better phrase. And even more so, it's become prevalent in day-to-day concerns. So if you think about it, it's been back since, 2009, 2010. And the available nil rate bands to offset the tax have remained frozen. So effectively, there's been a stealth impact in terms of the amount of IHT people have been paying. Then if you sort of factor in pension legislation, with pensions falling inside the estate from April 27, and the increase in certain asset classes such as properties, the overall impact is more people are paying IHT, and the people that were already paying IHT are effectively paying the higher now. So protection is just one of the many tools that people can use. And so that is why it's such a useful tool in someone's armour.
Yeah. So how would you run a session? So if I came to you asking for help with my estate planning and life insurance, how would the session run, and what would be the major parts in it?
If someone came to me and they wanted to talk about estate planning, I think the first thing that we would look to do is understand what their current situation is. So what I mean by that is basically ascertain what the IHT liability. So we would look at what their asset base is, and if they've got, say, liquid assets which have difficult valuation points, we would make sure that they were comfortable with the values that would be put to those asset classes. So we'd understand what the IHT liability is. And then at that point, we would say, well, look, based on the implications, how does that actually sit with you? Because for some people, estate planning and the level of IHT that they're comfortable paying varies. So once you've ascertained whether they're comfortable with potentially what the IHT implication is, we would then say to them, well, look, what does a successful IHT mitigation look like? Because for some people, it might be, well, actually, what they really want to do is they want to completely mitigate the IHT liability down to zero. And for some people, it's saying, well, look, that's unrealistic. So what does successful mitigation look like? And in terms of from a monetary impact, what level of reduction would they feel comfortable with? Now, once you've gotten to that point, at that point in time, you would then be able to say, well, look, let's look at all your options from a estate planning, IHT mitigation avenue, one of which would then be the protection option. Because typically, just from a financial planning perspective, if you're doing an estate planning exercise, it's actually a bit more of a blended approach. So protection can be a complete solution. It's a very simple option, but it would be very expensive. So typically what we would find is we say, well, these are all the options available to you, one of which is the protection piece. And how can then we build a proactive plan, taking different pieces and different strategies to come up with a blended solution which is tailored to the client and their needs.
Okay. And do you have any rough figures for prices for different age groups and amounts?
Yeah, Rick, no, absolutely. So before I sort of talk about a bit of an example that I've put together, I think if we just focus on the protection side in terms of if we're doing protection where it's life cover purely for IHT reduction, then there are two main types of protection policies that you could consider. So the first one is called whole of life. So that basically is saying it's a guarantee. So if you die, it will pay out a certain level of sum assured as long as you keep paying the premiums. Now, there's a different type of life insurance where it's term cover, and it's a if you die within a certain time frame of when the policy is active, it will pay out the sum assured. Now, because term assurance isn't guaranteed, it's typically a little bit cheaper, but that's because once it's outside of the sort of the term of the policy, it expires. So effectively, the premiums could end up being a bit of a sunk cost. Whereas the whole of life, because it will pay out, the premiums are a little bit higher. But typically what you find is the aggregate value of the premiums are usually a lot lower than the sum assured that is sort of being covered for. Now, coming back to your point, if that's okay, in terms of a bit of real life scenario. So let's say we took a husband and wife, age 70, and they had an estate of 2 million. Now let's assume they had not made any gifts, so they had their full available exemptions to offset against the estate of 2 million on second death.
Yeah.
Now, at the moment, assuming they had children to pass their house on to, they could be up to 1 million in available nil rate bands across the husband and wife. So that would mean that actually there's a million that's subject to IHT, which at 40% is 400,000. So assuming standard terms and that there aren't any sort of health conditions which might cause the premium to be uprated, if they wanted to do a whole of life policy where it's guaranteed to pay out, if they're accepted on standard terms, you'll be looking at a premium of around about £700 a month. So as long as they continue to pay around about £700 a month, on second death, £400,000 would be paid out, and that would then cover the IHT liability on a £2 million estate. Now, if you were to then say, on the flip side, well, that's a little bit too expensive, it's not very affordable, and what they're planning to do is a IHT sort of gifting strategy to reduce their estate, then you could say, well, look, if we were to do it on an 18-year term insurance, so for the next 18 years, if both of you were to die, it would pay out £400,000. The premium reduces to around about £250. So you can see there's a stark difference between the £700 where it's guaranteed on the whole of life to a term insurance policy of 18 years, and then it reduces down to around about the £250 mark. So very high level, but there's a big variance between the two different types of policies.
Okay, and that's paying the same amount every month.
Paying the same amount.
Yeah.
Now we unfortunately don't have enough time for me to talk at you about all the different features and flexibilities, which is why we always recommend speaking to a financial planner when you're looking at protection as a blended option or a solution in itself, in its entirety. Because like you say, that is based on the premium staying level throughout the term of the whole of life or term insurance. But there are so many different types of premiums, and there's a myriad in between. So it can really be tailored to a client's situation in terms of suitability. And sometimes I would also say as well on this one is actually it might be that you might have a blended option of, say, a little bit of whole of life or a little bit of term insurance, and you can package it up according to be very specific to each client's set of circumstances.
Okay, and so when you're going through this, you would plan out what's the difference between putting that money away if you're going to live for a certain amount of time versus putting it into a life insurance policy, and then
absolutely
options.
Yeah, absolutely. I mean, look, when I work with my clients, when I look at protection fees, it's really important for them to understand what the break-even point might be, just so conceptually they can understand. Because, sometimes people have protection's a really interesting beast where you're having to talk about circumstances or life events that can sometimes be uncomfortable. Thinking about when you might pass away, it's not really a comfortable thing to think about. But from a practicality point of view, if you're trying to build robustness into any plan, thinking about it as part of a solution, whether it's from, strengthening your underlying investment strategy or reducing your inheritance tax, it's a useful tool. So we would always talk through what the break-even point, what it would mean, because a lot of people, sometimes they have preconceptions of seeing it as a bit of a sunk cost, because ultimately it's something that you're not wanting to happen. But you also want the peace of mind that if something were to happen, then your loved ones would be okay.
Yeah. And like I've just completed on a new mortgage, and like I've been offered lots of protection policies and things like that. So if people are getting offered these by mortgage advisors and accountants, what should you be aware of when not looking at it as part of a whole estate planning service?
Yeah, so I think it would be, accountants and the mortgage brokers that offer protection as an affiliate service or an ancillary service, should I say? If there's a difference between a specific bit of life insurance to cover a certain liability like the mortgage. Whereas if you're looking at it from a estate planning angle for inheritance tax purposes, it's fundamentally different, because it comes back to the point that I made earlier when we were speaking about, protection can be a one-stop solution. But if you did want it as a one-stop solution for IHT, it would be very expensive. But it's not the only option, and it might not be the most suitable option, because actually one of the easiest ways for people to reduce IHT or inheritance tax is to spend more or do gifting. And then if you wanted to do that, you've got to decide on like, well, what's then affordable? And to decide on what needs to be affordable, you need to then be able to do some modelling. And then you need to be like, well, if you're then going to do some gifting, where do you then take it in terms of the most tax efficient manner? And those are all the sorts of conversations that any good financial planner should be doing with their clients. And so everything in terms of clients' financial planning and goals and aspirations, they're all very much interrelated, because they all have knock-on effects. So a financial planner could work with, or should be, if they're doing a complete service, would be happy to talk to the accountants, or maybe have conversations with the mortgage brokers, just so you can all sort of be singing off the same hymn sheets. But it's really the financial planner that can bring it all together. Because what I would say is not all financial planners would maybe necessarily do the protection piece. So it might be that they ascertain the need, and they then might need to bring in a protection specialist to then be able to do the regulated piece of advice as well. But what I would say, coming back to the main points, is that if you're doing protection for estate planning IHT within mind, then you should definitely bring in your financial planner to be able to help center the focus to make sure it's going in the right direction.
Okay. And there's one final thing I'd like to cover, and that's just the role of trusts and what role they play in it.
Yeah, look, trust is really important. So if we talk about IHT and when it has to be paid, it has to be paid pretty much 6 months from sort of the date of death and the IHT liability arising. If you look at generally speaking nowadays, a lot of people's estate is primarily comprised of someone's house, which is a liquid. So let's say if you were coming back to my client and of the 70-year-olds, and that £2 million estate was comprised of a 1.75 million family home, and they've only got £250,000 in accessible liquid cash, well then they would need to effectively have to sell the house within 6 months to be able to get sufficient liquidity to pay that £400,000 IHT liability. Now, this is where protection can come in, because it can provide the liquidity to help pay for the tax bill. But the way that the trust bit comes in is that by having it written into trust, then it doesn't need the grant of probate to be in place to pay out. So it pays out very quickly, providing that liquidity to pay the IHT bill, so that the executors of the estate can get the grant of probate and then sort of disseminate in line with the wishes of the will and the deceased.
Okay. So an important and critical tool.
Yeah, absolutely. And what I would say is all protection providers will have their own trust documentation. So it's a very standard process that even if you're doing life cover, say for just your mortgage liability and not for IHT purposes, or for a lump sum for your spouse on first step to provide additional monies to help with childcare, typically seeking, it would always be written into trust, just so that it's outside of the estate for IHT
Yeah.
purposes, and that it can be paid out in a quick and timely manner.
Okay. Alex, thank you very much for joining us. And thank you for watching, and do get in touch if you'd like to learn more.
Well, thanks so much.